Let's get going. Good morning, everybody. I'm Arthur Mrozowski. I represent Silicon Hill Ventures, and I'm based in the Bay Area. Talking to you guys from Santa Cruz today, office in San Francisco. But I don't want to talk too much about myself. I much rather talk about the great panel that we have today, and then we're going to be talking about the venture capital of 2022, which probably is kind of like summarizing what had happened in over this year, because we have all the numbers and kind of understanding of what's going on. So the numbers are actually going down in terms of the companies raised $37 billion in the Q 2022, down 37% from last year, the same quarter. But at the same time, still raised like $151 billion to the date, which is decent and record-breaking number anyways. And then another subject that we should be talking about today is the fact that geographically, a lot of the VCs and a lot of the Bay Area, it's expanding in terms of at least technology. Actually, and Miami is playing a significant role right now in getting into the game. But in any event, enough of me. Let's have the nice introduction to the panel. I will start with the Peter Thurlow and then talk about him and who he represents, and then we'll go to the next panelist, and then we'll start our discussion.
Hi, everyone, and thank you, Arthur. Peter Thurlow. Many of you may know that I've been hosting the meetings, at least 3 in New York with Marty for the last few years. Been friendly with Marty for the last 5 or 6 years, and I was smart this time. Came down to Miami from New York to get some nice weather in December, and it is as nice as everyone says. So it's nice to be here today. I'm actually the unconventional person, maybe not the only one, as an attorney. Partner in a law firm, but I get to this spot because I joined my law firm Polsinelli 7 years ago after working at a big firm, Jones Day, where we were buying companies. I went to the startup side 7 years ago and focused on IP, but quickly realized that every company I work with needed capital. So I started hosting family office meetings, and now I work with a number of family offices and share a deal flow with them. As Marty said, I thought my deal flow was pretty good until I met Tim Draper last night. I was in the thousands, so it was a fascinating discussion we had yesterday with him. But so a lot of the work I do is connecting founders to family offices, and then family offices to founders, startups with low valuations and great opportunities to get involved. So let me stop there and let Steve or Milton jump in.
Okay, Steve. I know your partner, Julia. I talk to her all the time, right? But please introduce yourself.
Great, thanks, Arthur. I'm Steve Brotman. I'm managing partner at Alpha. What we do is we invest with other VCs on their best opportunities. So, for instance, there are about 2,400 VCs in the U.S. About 1,500 of them have less than $100 million under management. 95% of the time after the seed round, they have pro rata rights, which they don't use. And we step in and at that time and actually share our carry with those VC firms. We started about 10 years ago. We manage about $500 million. And take a little bit of a different approach than Tim. There are 1,700 growth stage deals that were done last year, and we get sort of proprietary access to about 30% of those deals. So by partnering with the existing VCs, and it can be family offices, we can go direct without that, but that's sort of our secret sauce. And we do about between 4 and 6 deals a year. And deploy about 5 to 15 million per deal.
Great. Milton?
Hi, my name is Milton Vescovacci. I'm an attorney here in town in Miami with Gunster. The law firm is a statewide law firm, 13 offices statewide, exclusively in Florida. We are a law firm that provides full services, but we started out as a practice of lawyers that were in the real estate market and family office representation, primarily starting out with the trust and estates planning and the probate litigation. The firm, since it was established 100 years ago in Palm Beach, has grown to 260 attorneys statewide. And now it's a full service firm. We provide all types of legal services with some exceptions. Our primary practice areas continue to be the ultra high net worth planning and probate litigation. We do a lot of work with the family offices as a result of that. So we set up family offices. We help guide them through their execution of private investments. And we do all the administrative sort of, advisory work for them from the legal side. We do nothing on the financial or non-legal consulting. We work with others, obviously. And so in the venture space, we help these family offices and then the venture capital investors. We represent angel investors and some individuals who are managing their own proprietary funds in execution. And so that's one of our practice. The other part of our practice is working on the company side. We're entrenched throughout the state with the various incubators, various universities, tech transfer offices, and accelerators statewide. And as I mentioned, we provide services from like birth through IPO. And in the middle there somewhere, our M&A practice, of which I belong to, helps secure those types of exits. And when the SPACs were back in the popularity, they were also competitive. Florida's been a very active market in the venture space, as you all probably know. And we'll talk a little later about the dynamics of the Florida market. It's very different from city to city.
Great. Well, thank you. Let me start with you, Peter, on a question related to the fact that we know what the current situation is, from the venture capital point of view. I mean, it's kind of bad, but but there's still plenty of money. But my question to you is this: like, how's that relate to the family offices? What's the situation with the family offices, and how does how do we compare the VC versus family office?
Yeah, so thank you for the question. I think obviously Steve is more connected to the VC area. I focus more on the family offices and look at capital flow from many different areas. And I attended yesterday's meeting, the full day of the meeting, and then the dinner last night, and I heard different versions of the VC area and concerns from the family office space. When the deals get to me, it's still very positive. I'm old enough to, like many of you, to have gone through 2008 and know how the capital flow just stopped. That is not the case now. I think there was a gentleman on the panel yesterday on real estate, one of the attorneys saying he's never been busier. And now on our side, it's very similar. We have lots of deal flow. Just in the last 6 months, I just wrote down a bunch of deals that we did. A life sciences company where I work, they get like $40 million funding from a family office. We will set up the corporation, we'll handle all the VC work and handle the IP work. And then we introduce them to strategics and try to scale the company up. But there's been a lot of deal flow from $6 million deal. I remember, Marty, a year ago, we spoke about a company that is making alternative plastic products using almond waste. There's 1 billion pounds of almond waste. Happy to say that company got $6 million of funding, is on its way to a really successful future. Other deals, the stem cells, someone in the earlier panel mentioned stem cells. We have a stem cell project in the fertility space where KKR just put in $3 million. We closed around on that. They hope to get some good data and get acquired in just next couple of years. But there's a lot of deals on the table. We haven't seen it dry up from family office space. I know there's a lot of very reasonable concerns on the VC side and the overall state of raising a fund. But by the time it gets to me, the money is normally in place. And then to the extent there's a lot of great ideas went on yesterday about obesity, about cell culture analysis, you know, what Michael Tippy is doing with the universities and foundation IP and trying to spin out companies. So I still think there's some great opportunities for all that. And what I see in the family office space is very positive.
Great. And then you're in New York based, right? And you also are taking care of a lot of IP aspects of it, right?
Yes, yeah. So my heart, anybody, most of the time I mention IP or patents and people say, please stop. But you saw in the earlier panel, there's just an interesting example, a lot of IP patents. Congress did a review years ago, and for family offices, they value the intellectual property of US companies at $5 trillion. So if you look at the importance of some of these drug-related pharmaceutical patents, they were so important that the US Patent Office was challenging the validity of a number of the drug-related patents. So they actually transferred the rights to Native American tribes. That case eventually went up to Supreme Court, but it delayed it enough where they were able to work out some financial benefits to the drug companies. So there's a lot of things that go on. We have several deals now. It's just not about getting patents or litigation. We have several deals, patent financing. I mentioned to Tom where two $20 million patent financing deals, one $250 million. Then unfortunately with the state of the economy, the most valuable asset when a company gets distressed or goes into bankruptcy is really the IP. So I know this is focused on VC, but from a total capital analysis, which is when I'm focused on getting capital to the companies, sometimes the remaining value in the company is the IP. And we try to have several deals going on now where we're trying to get money to the companies before bankruptcy, or if they go into bankruptcy, we have buyers of family offices that are actually buying the IP out of bankruptcy, then spinning out companies and trying to develop, because that's a later stage company. So
sounds good. Milton, can you tell us about what's going on with the for first time I did notice that in geography Miami is important. I noticed my kids, they're all in the high tech and they have the well-funded companies, and they migrated like birds to Miami last winter, and they really wanted to actually move in, but eventually they kind of stayed in California. But I understand that there's a huge VC and tech hubs that are being that are being created right now in Miami. Can you tell us a little bit about what's going on and where are the hubs? Are there in the Miami? I mean, in Florida is big, but is it Miami only, or what's going on?
Sure. So I've been here for 21 years from New York. Over the last 21 years, I've seen the Florida market grow exponentially. Miami has been the beneficiary of the largest growth, followed by Tampa and Orlando following that, and then Jacksonville. Each one of those markets is very unique. And there are other markets, the Fort Lauderdale, West Palm Beach market is also very robust. But each one of these markets are very different. Traditionally, Miami was a healthcare and software technology market. It continues to lead in that space. It used to be primarily focused on Latin American software companies and healthcare companies that would service what they call the healthcare travel, like plastic surgeries and stuff like that. Miami is no longer that. Obviously, fintech is now the sort of the leading industry for Miami, and in part it's attributed to the local government's emphasis and focus on branding Miami as a fintech hub. There are in the state of Florida, all different industries, agricultural technology, educational technology, aviation, space exploration technology. If you go through the entire state, you'll find all these different industries wherever you may go. North, you'll find a lot of manufacturing, magnetic technology development. As you go to the east, northeast, you'll find more financial services. Miami being the hub of the Latin American financial services, leading in that fintech world as well. And so with, since COVID, what happened was it became a more concentrated sort of ecosystem, because we had folks from other markets come. They thought they were coming temporarily just to ride out the pandemic. And what they realized was that it was a dynamic market and they can do their business from here, formerly from New York. I mean, I realized that 21 years ago. I continue to do business in New York, travel there 3 times a year, but I don't need to be, domiciled there, nor have to pay all the taxes and deal with all the regulations. Florida, as you all probably know, is a, pro-business climate, very easy to do business here. And once you get settled here, the community is very connected. The 6 degrees of separation really truly exists down here. Everyone knows each other. There's somebody who knows somebody you know. And so to do business, it's much easier in an environment like here. Now, it's still a very transient environment. So you get, unfortunate news like, the FTX occurred, with a severe, impact on the market. But hopefully, that will, subside and we will continue to grow. But the market in Miami is continuing to be led by the healthcare, the technology, the fintech, agriculture. Real estate is obviously an important industry for our entire state, but Miami is one of those leading areas where that's primary focus. So a lot of technologies developed around the real estate market. Insurance tech is another area, and obviously medical, medical technology development, product development is something that's very, very vibrant here. The medtech area is more towards the north, where there's a tech corridor in Orlando. There's a whole hospital, healthcare city built around that. We have semiconductor manufacturing that's occurring in the state, in the sort of the Lakeland area north of Orlando. So yeah, the market is very vibrant, a lot of different diverse industries. In the venture space, we still lack venture capital. I mean, we have some homegrown venture capitalists in Florida that will invest in state. We need more. We still find that the later stage companies have to go outside of Florida to be able to raise capital once they get to the B and the C rounds. So, we welcome Steve and his colleagues and his active participation down here.
Great, thanks.
Yeah, talking about it, Steve. What is your view on in general? Because you have a great experience as far as the family office is concerned, and also in the VC. And what is your view on where we are going to be in 2023 in terms of both cooperation between the family offices and then a little bit of a competition, and in some sense, what are your thoughts?
Yeah, no, I mean, I think we're going through a pretty big phase shift. About $500 billion was deployed last year, in venture total. 2/3 of that were from more transient sources, corporations, hedge funds, mutual funds. We're not talking just early stage. We're talking 80% of all venture capital is later stage. of that 500 billion, 400 or 450 is sort of later stage capital. So we're not talking about early stage capital per se. And so with sort of 2/3 of the capital leaving the building, that's sort of, so, if IPOs aren't getting done, that means E rounds aren't getting done, which means D rounds aren't getting done, which means C rounds, B rounds, and that sort of filters down all the way down the whole chain. So it's going to be a pretty interesting environment. You mentioned how deal flow is sort of slowing down dramatically. It slowed down about 50% in like Q2. It could slow down as much as 75% this quarter, and next quarter might be worse. So that's mostly impacting a lot of later stage companies. Early stage companies, there's definitely been stacked up. There's more powder and venture capital looking for early stage stuff than there's ever been. So it's a pretty robust capital system for early stage. Family offices also are kind of hanging in there. They got a lot of liquidity over the last couple of years, cashed out of their businesses. Private equity bought a lot of those. A lot of their companies went public. So families, especially if they exited, have done really, really well. And so it'll be a very interesting situation because of the amount of probably distress in general in the economy. Later stage companies are going to be under huge amounts of stress. It'll be interesting to see what happens to early stage investors. So for instance, if you seeded a company for a $10 million valuation, and now you can invest in a $10 million company that's doing $10 million versus a seed stage company at a $10 million valuation, what are you going to do? Are early stage investors going to be like, you know what? We don't have to do zero revenue companies. We can move upstream and interesting companies that might have IP, right? So I think it's going to be definitely sort of a bit of there's definitely going to be a lot of change, but it's going to be a little bit of a fight between sort of the economic situation and the capital, because there's an avalanche of capital. So there'll be an interesting sort of war between those two. Sorry, Marty.
Arthur, I have a question, just so you know. So there's a pretty, I would say when interest rates are pretty low, there's a pretty robust ecosystem in the VC space, right? And so, I mean, there wasn't just a matter of VCs who were full of cash. There was a lot of external investors who were coming into markets who were like hedge fund guys, private equity guys, bankers who had some money on the sideline, et cetera. And, it seems like there's been a pullback in that, number one. And then number two, you also heard about a lot of other areas where you could find investment, like some guys would take their companies public in Canada or look to go public in UK or something like that, or in Australia. I think it's one of the big places where a lot of fintech companies started. So are you seeing there's a pullback in that as well? I mean, from an ecosystem point of view.
Well, that's what I was saying. It's 2/3 of venture capital just walked out the door.
Right. Okay.
So 2/3 is gone. That's from all those different sources. There's 2/3 of the capital were tourists, people who historically they were attracted by the opportunity. And
Tiger Global.
Well, Tiger Global, yeah, I mean, they've been around for a while. They're just sort of the epitome of paying the top tick and just being momentum investors. So SoftBank is one of those. $100 billion fund is not going to be repeated in our lifetimes.
Right.
That's just actually historically $1 billion funds of the $250 billion plus funds. How many do you think made more than a 2x return?
Oh, I would say almost none.
5.
5, really? Wow.
Yeah. It's so the amount of, capital destruction is going to be pretty interesting. But to your point, there's a lot, PE funds, hedge funds would create side pockets that historically invested in liquid strategies. They created investment vehicles to invest in startups. And even Tyra Global, all of a sudden now they're a seed investor with $10 billion. We'll see how that goes. But it's gonna be a really interesting environment, and I think families are actually really well positioned here because I think they probably many of them, some got it over their skis, but most are pretty realistic that this is an asset class that you put a couple points of your net wealth in, and I think they're pretty longer term, and they're longer term investors. And they've gotten much more sophisticated. So I think to Peter and Milton's credit, helping them mature. That's actually we're backed by the Pritzker family, and we work with about 200 family offices. And as I mentioned, we do co-investing with other VCs. And so what we do is with every deal, we allow our families to participate alongside. And more families are realizing that it's smart to, if you're wanting to deploy directly into companies, it's really wise. Tim Draper actually was one of my first investors in my fund 20 years ago. So I've known Tim for a really long time. I raised a $15 million first time fund, and he put in $1 million, and his partners did as well, which is amazing. But the point is like families are beginning to realize, hey, if I'm going to do this, why not have someone like Tim, pro VC to bounce ideas off of them, invest in their fund. But that's the superpower that family offices have. And actually Pritzker learned this as well, as they used to have, they have a pretty decent sized venture program, but they realized one thing. And that was they looked at their venture fund of funds program, and they invested about $20 or $30 million into 10 fund of funds. And they also had $500 million they deployed in venture capital. Their fund of funds program returned 8 times their money, which is completely absurd for a venture fund of funds program. The only thing more absurd than that is that when they directly invested with those funds, co-invest with those funds, they return 9 times their money.
Wow.
So what do you think they decided to do? They're like, what are we doing? Trying to compete with all the VCs out there.
Right.
Let's invest and co-invest with these guys. It's the superpower that family offices have that they fail to realize. They think, gee, if I give money to a money manager, that makes me a bad person because I'm paying them fees and carry. No. You're getting value from that. If you invest in someone like Tim Draper's fund or our fund or other venture funds, and you particularly look for those funds, as I mentioned, of the 2,400 VCs, there are 1,500 with less than 100 million under management. So you write a $5 or $10 million check to one of those VCs, and they're an ed tech specialist.
Mhm.
They'll run circles around anyone you hire and probably any generalist VC. If you like a particular segment, I think I've particularly found that the smartest families are ones that partner with VCs and they get educated. They not only learn from what the VCs are doing and incorporate that in their own direct investing. And I think that's if you don't do that as a family office, you're missing a pretty big trick. So
One thing I just to go back to the money, everything Steve is saying, I read and I agree with, and he's much more in line with that. But with the family offices that we work with, we look at investments, there's been a real change and obviously the valuation of the companies that we're looking at. So let me give you a quick example, just from a personal standpoint. Got a truck, 75,000 miles, we're looking at getting a new one. This time last year, we would have paid, top price. Just to look the other day, it was reduced by $10,000. Looking at a second home so I can actually come to one with a client in December or January, and those prices have completely, just I think early stage, been readjusted. it's the same thing going down to what's considered more of a real valuation. It's the same thing from some of the deals that we were looking at last year to this year. It's just, there's more realistic investment scheme where maybe the investment didn't work last year, now it's working this year because the valuation, the chunk of the company that can get, it's just a much different. So again, I generally have a positive attitude on this, but where the overall amount of money in the VC area may have gone down, the valuations of some of these exciting companies have gone down. A lot of companies, I mean, exciting part of my career, I got the email from Tim Draper this morning saying, let's find ways to work together. I was like, yes. This is, I think it's exciting time.
I was gonna say, just because the volumes are going down doesn't mean that's a bad, you want to be greedy when others are fearful.
Exactly.
So,
Like Warren
so it's
Buffett said
actually,
something like that.
right, I was
Yeah.
gonna mention, give Warren some credit for that, but that's, I don't want to say that just because the volume's gone down, that's the wrong time to invest. One other thing that's interesting, but it's hard to do that. It's hard for families to, when the rest of their portfolio is falling or having issues,
Sure.
to get that gumption up. But it's actually over the last 3 or 4 recessions, the return rates during a recession are higher during the recession than the 12 months before the recession. And the interesting piece here is that they're even better the 12 months after the recession ends. So, you know, that now is actually, if you didn't invest, like if you feel like you didn't invest enough over the last 4 or 5 years, that's great, because there was, I think it's gonna be shown that those vintages are gonna be horrible. They're gonna be horrible. They're gonna be like 99, 2000 vintage types of things. It wasn't really until 2003, 2004, after the crisis, that things really got great. And I made I've made most of my money in downturns, deploying during downturns. If you think about it, like psychologically, anytime you've invested when things are down, you'll do pretty well. But particularly in venture, and for families that are thinking about doing more venture, you know, it's as much as like, I would say that, like, I'd say it's only going to get better over the next 2 or 3 years. I don't see it like valuations spiking next year. I think if anything, you can be more prudent, you can do more diligence, you can do more work. I'm more excited about the venture asset class today than I've been in years. So this is, I'm not trying to sell my book. I think I'm being pretty, I've slowed down my investing over the last couple of years, and it's been frustrating to me. It pisses me off. So I'm really excited to get back to rationality. And the whole FTX thing, that's just sort of the apex. That's the apex of lunacy. And it's gonna, the good news is I don't think people are gonna continue. There's a lot of lessons there. And go ahead.
Well, since you brought up FTX and there are a bunch
Yeah.
of lawyers in the room, what are your thoughts on FTX Ventures and their fintech investments? I think they invested in more than 50 companies. I have to imagine if they go down the Madoff path, there's going to be a clawback and liquidation of their investments. Is that right? Any thoughts?
So we're involved in the bankruptcy there. So we, Polsinelli, I can't mention it, but it's obviously a big deal. And I think the analogy that you give to that is a really good one. But it's gonna, I think someone said that the Madoff thing was going on for 12 years or something. I mean, it's gonna be a long process, and
they recovered a lot.
They did.
Didn't they recover a lot?
Incredible amount. The gentleman that ran that did a fantastic job.
What was the
Getting my money
percentage? It was like
back.
80% or
Huge
something.
percentage.
I think
Thank you. That's me, my firm.
Wow.
Oh, really?
My partner, Irving Picard.
Yeah.
Irving Picard, right?
Yeah, Irving Picard, yeah.
Are you doing
Congratulations.
this one too? Is your?
No,
are you
I've been
doing
able
that?
to retire as a result.
Oh, good.
And he moved to Miami.
Excellent.
Very smart man. Yeah, good for you.
So you think it's going to follow that same path? Because I think there's a lot of fintech investors, and that ripple will be significant in fintech, right? Because the valuation will have to change because you're pulling back $10 million that was invested in a firm here, 5 million in another firm. I mean,
Absolutely. It's all
they came in and
they're
played
going to all
really
come. I'm going to talk about that, those kind of issues, the bankruptcy clawback issues that on the panel, we're doing in 2 hours.
Fantastic.
Yeah,
We're
just
not-
They're gonna be
quick
able to
comment.
claw, so hold on
Yeah.
a second, they're gonna be able to claw money out of the companies they invested in.
So they put
Yeah.
in 10 million, they're gonna
Because
take
it's
it back, and if
under
it's
the-
been spent, they're gonna liquidate the company.
So I listened to a business show. Anthony Scaramucci did a deal with FTX like a few months right before everything collapsed, and they acquired 30% of his company. And he was a big fintech guy. He had the big Soul conference in New York. Everybody was high on it. A month or two later, everything's changed. So he's one of the guys that's saying, hey, what's gonna happen to him? So there's
Yeah, I don't
a lot
know.
of lawyers making money.
Plus Scaramucci was allowed to buy 10 million of FTT token, right, at $50, which is now worth $1.
And then he took Sam all
Got a
over the
deal.
Middle East.
$1
Yeah, he took Sam all over the Middle East to raise another $1 billion of funding.
Oh, did he really? Yeah. So I think that's just, I'm just saying that the ripple in fintech venture capital, with New York as many, is gonna be significant, because that clawback will lead to liquidations, I think. right?
Until the federal, I don't know this area at all. It's the next panel, but until the Federal Reserve backs it, I don't see any sense. But again, let the next panel discuss that. It's a frightening area. I don't know.
No,
Yeah.
I know it's gonna take a long time. We met with a Bahamas-based law firm that what they do is, helping the restructuring of companies. And their expectation is that it's gonna take, years before they can be able to, identify where all these assets are.
It took us 2 years before, first of all, my firm is still handling it, my former firm.
Yeah,
So this was from 2000, if you don't mind, 2008, right? So now it's 14 years.
Wow.
Yep.
Number one, we're still getting paid fees. Now, we gave a discount. We don't get paid a penny from what we collect. I do think one observation thing I will make here, if you don't mind. So I do think the number is gonna be substantially less than people think of losses. Just like in Madoff, everybody thought it was gonna be 60 billion.
right.
That was just paper losses. In reality, it was 18 to 20 billion. So I think the 8
Right.
billion people are throwing about, maybe 2 to 4, maybe 5. Okay.
Oh, you're saying that people might have bought it, but then the tokens went up.
No, because of the clawbacks, because of the recovery that you're gonna be able to get.
Interesting.
So we got back in recovery of the 18 or 20 billion, 14 billion already. Okay, and we paid out 12. The
Right.
payout though didn't start. We investigated still to this day, but the first 3 years were really tough. 3-4 years were key. We brought most of our actions 2 years because that's the bankruptcy, fraudulent conveyance claims have to be brought within 2 years, which is stuff your partners would know. Okay, and so we ended up bringing over 1,000 lawsuits, and against financial institutions, against anyone that received preferences, which means for an insider within the last 90 days
Yeah.
before the bankruptcy or a year before the bankruptcy for non-insiders, or 2 years for fraudulent transfer. So to get back to your point, though, if there was value and consideration given for some of the investments, then it might be a different issue about whether or not you can claw back those issues, because that's the standard for fraudulent transfers. But there's an element of scienter and knowing that something's funky. So those were the kind of claims, like we got back $250 million from Chase, who was the banker for Madoff, claiming that they should have seen him stealing the money
Yeah.
from the customers and using it improperly. But anyway, I don't want
Yeah.
That's just-
Why don't we go back to Florida? 'Cause
Okay.
I think that seems like, it sounds like you'll cover more of that later. And if you don't mind.
Arthur.
Sure, go
yeah.
ahead, please, please.
I think, right today, Florida is still, it's actually like probably in the top 10 of venture areas, top 10 with Silicon Valley, New York, LA, Boston, being like in the top 5. San Francisco, or Florida's sort of has 2 or 3% of all venture capital deals are done, which is actually not that bad. It's up from like
It's up in the last few years, right,
1%, 10 or 15 years ago. And it's similar to Texas, which is sort of surprising. But the interesting part about Florida is that there's a tremendous amount of investor capital, and a lot of that capital is generated from entrepreneurs who made it in other states, and then they came here, and they're going to continue to invest. The biggest investor, one of the wealthier guys in New Jersey left New Jersey, came to Florida, was a big hedge fund guy. All that money is going to be funneling somewhere, but it's a prerequisite for doing risky projects. You don't do risky projects if you're a subsistence farmer, right? This is the deal flip, like the supply of deals, just is really the limiting factor. There's plenty of capital here, and I'm actually, but the ecosystem takes a while to grow. I think there are people who are, like, as you mentioned, where you can, I know 3 or 4 of my compatriots from New York have moved down to Miami and set up shop here. And you can do that in today's world, whereas even 3 or 4 years ago, you really couldn't do that. So it's really interesting how that's going to develop. And the Florida ecosystem is really lacking a big win, like a software company or a true technology company. But for many, many years in the New York market, it was similarly situated. Austin's the same way. That's the next level that you'll know, okay, that Florida's come of age when they start producing big winners. And because that directs venture attention and investor attention is, okay, you can make it here. If you can't create big companies here of lasting value, that's really going to be the key point. But the interesting piece is that because of the amount of wealth here in entrepreneurial hands, it's just a matter of time. So it'll be interesting.
I can give a plug for from an outside standpoint. Come from New York, we have a very strong university system, and we see, I focus a lot. Michael Tippy discussed a lot. Just university IP is really a key to innovation in the country. When I was growing up, when I looked at Miami, it was always Miami Hurricanes and Miami football. And now I think, and Milton can describe it much better than I, but as we work with University of Michigan, as we work with even Tim Draper mentioned Utah, we work with some universities out there where those companies are seeding. I think University of Miami has a really good reputation. Donna Shalala, I think, was former worked in the Clinton and Obama administration, I believe. But I think they need that incubators to start the ideas for here. And I think University of Miami is doing that, but you tell me.
There's a research park right here, life sciences. It's run by the University of Miami, and it's Health Network, not too far from where we're sitting. I want to echo what Steve and Peter had said about the market, the expectations of the venture investors and family offices and their strategic relationships. I personally worked on a deal where we were the anchor limited partner for a new growth equity fund, and their focus is on government technology, which is very sort of what do you call that, esoteric, in that it's not common technology, but it's an expertise that the founders have, and they've been able to acquire some very interesting companies in that space. In terms of the family offices, waiting to get in at the opportune time, I see that. We're currently looking at deals where the valuations are suppressed from where they were 2 years ago. And so they're much better deals. And I agree with you in terms of, overall return on the investment. If you're able to wait, which family offices typically have that flexibility, then they make the better investment.
I would add that, the university system is really pretty critical. I actually looked at my kids looked at University of Miami, or Miami University. My wife went there. And so, we had to go stop by, and I was like, oh, we'll check it out. But it is really actually impressive what Donna Shalala did, and the school footprint is pretty impressive. And I came away being like, wow, this is a real school. And that's great to see. I will say there are lots of other schools in Florida, and a lot of kids want to live here. And that's the thing about Silicon Valley, that I think people it's still the hub. It's still where I think half of our investments are there. But there's a large sucking sound from the rest of the country. And particularly in places like Texas and Florida, New York was a beneficiary as well, but kids like to live in Miami, they like to live in Austin, and they like to live in New York. That's where these startups go. You know, that's the future. Kids are leaving other parts of the country to come to places like Florida.
I think Orlando has a pretty fantastic environment for entrepreneurialism.
Yeah.
University of Florida is there, and
Yeah.
if you're a national merit finalist or semi-finalist, you get a free ride to go to University of
But
Florida.
it's also, it's silly how expensive it is to live in Silicon Valley
Yeah.
or in New Jersey.
Yeah.
I mean, it's
Where I live,
crazy
it's awful.
expensive. So like, I mean, you know, and then you layer on healthcare expenses and everything else. If you're a young person, you know, you can't afford to live there. And, you know, so I think, I mean, that's something that.
Yeah, I agree with that, but you know, Steve, honestly, everybody, I'm gonna be local patriot here, right? Because I've been living here for 40 years and all my life, and I've seen the turnarounds, and everybody was saying, hey, the expense of living in California is going to eliminate the hardness of the technology, but that never ever happens, and and you know, don't tell. I mean, I can see like Draper moving into the Palm Beach, you know, eventually, but it's not going to happen. The core of the IP, and then I think the foundations of all of the good institutions like Stanford and Berkeley and so on, that are, you know, producing FTXs too, but you know, but 80% of all those good things
I would,
here. And what's going to happen is 30% of the downfall of the real estate right now that we're seeing in San Francisco area, and the cleanup that is happening will make the California more competitive as being number 5 economy in the world, right? So, but I don't want to just say that as a local patriot, but you need to be on the ground. We see those things.
yeah.
Last thing, if I may, I wanted to just talk to Pete. How much time do we have, Marty?
1 minute.
1 minute.
Yeah, I just wanted to talk with Pete, because he has a really interesting hybrid of potential VC family offices, because he's been involved in a DARPA project. So just like to summarize and tell us about like this opportunity in DARPA.
Yeah, thank you, Arthur. So many of you that may have attended the New York meeting in September, thanks to Marty, we actually had the representative Cecile Manning. She goes by Shaq, which I love because I love basketball, SHAC. She spoke about DARPA, anybody that wants to watch that video. And what DARPA provides is just non-diluted funding. So my experience with them, I'm going to help them with IP, with commercialization, with feeding them deal flow. Most of it you can appreciate as national security related things, quantum computers, cybersecurity, AI, those technologies. But for those of you that listen to the presentation, there's obviously a lot of concerns with global warming and so on. I'll be in meetings next week with them, next Wednesday at DARPA. And as Marty knows, there's a group, Incutel, which is the VC arm of the CIA, that we'll be meeting with too. So the nice thing is, again, it's non-dilutive funding. Quick example, if anybody wants to look it up, it's public. On-demand pharmaceuticals, they received $80 million in funding. They're making drugs in the United States based on technology. They can make any drug. I mentioned it to Tim Draper yesterday. I said, Tim, they got $80 million in funding. He said, Pete, they're not really a startup to me. I said, well, it's government funding, non-diluted. He says, let's talk. So there's a lot of interest if you can get that kind of work with a company that it's gotten to maybe first base, second base, and then the cap table is very friendly to family offices. So anybody wants more information about that, let me know.
Yeah, let me add to that, if I may. Florida Institute of Research is also an organization here in the state that provides non-dilutive funding. Space Florida is also an organization that provides grants and non-dilutive funding. So there are sources within the state of Florida that will help early stage company for some of the development.
Great. Well, this was a really good panel. Actually, Flo kind of by itself, and a lot of good information. Thank you, Steve. This was hugely educational, Peter and Milton, and let's move on to the next panel.